thank you guys so much for coming. I see a few familiar faces and a few people I haven't met before. One very familiar face. My husband is in the audience right there. This is the first time he's heard me speak, so I hope I don't mess up. But I really appreciate all of you guys coming. I know from experience there tends to be a lot of questions, so what I want to do is do my presentation first, about 15 or 20 minutes, answer questions, and then if we have more time, I have some more things I can share. But just so you guys know a little bit about me who don't know me, I've worked more than 20 years as a CPA in a variety of roles. I worked in litigation services, I have worked in business valuation firm, and a traditional CPA firm. In 2014, I created Accounting We Will Go. It's a Facebook group. I don't know if you guys are a member of it or not. I created it to teach e-commerce sellers the basics about bookkeeping and accounting for an inventory-based business. My group is free. It always will be free. It's kind of my way to give back to the community. When I first started it, I didn't even know if I would get 100 members, so the fact that we're actually approaching 10,000 is amazing to me. I run it like NPR. I keep it very focused. I do not allow anyone to advertise in there. It's all about accounting and bookkeeping. Let's see. You can also find beneficial training courses and information about my bookkeeping services on my website, accountingwewillgo.com. And if you ever want to email me, you can send me a message through Facebook Messenger, or you can email me at onlinesellercpa@gmail.com. So, I think we have a few more coming in. Welcome. So I'm going to go through a few need-to-know things. This is my wish list of what I wish every single person selling online knew and understood about this business from an accounting perspective. Do you want me to go back so you can get that? Okay. He started to take a picture and then he went, right when I changed it. And I have some cards too. I can give them out at the end if you guys would like my card. And just so you know, I provide bookkeeping services. I do not do taxes. I outsource all of that, but the bookkeeping is the underlying detail for the tax return. And I work with other people's CPAs at tax time to help them out. So there is a link there. It's just not a specific thing I do. All right. The number one need to know is please understand the difference between these two important measurements, gross profit and operating profit. So the gross profit is the total sales, it's the revenue. That's the number that everyone knows. Everyone can tell you how much they sold, and that's really important. So the gross profit is the revenue less cost of goods sold. And cost of goods sold is defined as the cost of your cost of inventory. So you have the revenue for what you purchased or for what you sold, and then the cost of goods sold is what it costs you to acquire that. So if you bought something for 10 and you sold it for 30, the difference is 20. Remember, you'll never be able to calculate the gross profit if you don't know the value of unsold inventory on hand. This is so, so important. And this, I think, is the number one thing that concerns me about e-commerce sellers when they can't tell me how much they've spent on unsold inventory. And you really have to keep an eye on this number. First of all, you just need to know what it is because you need to know whether you have 10,000, 100,000, 50,000. You will have a personal comfort level. Some people have a number that's much higher they're comfortable with in unsold inventory than other people. It's also a seasonal thing. You might want more unsold inventory as you approach the holidays, Q4, if that's the kind of selling you're doing. So it's really important to know that number. So the operating profit, that's the bottom line. That's the number that you pay taxes on. It's the profitability of the business. And this number obviously really matters too. To determine operating profit, operating expenses are subtracted from gross profit. So really easy example. Let's say you sold $100 worth of items. You paid $70, well, no, let's do it differently because that's not realistic. Let's say you had $100 in sales and it cost you $30 to buy the inventory. So then you've got $70 as gross profit. Below that is all of your operating expenses. These are things that you are indirectly in control of. How much you pay subcontractors, how much you spend on advertising. These are a little bit more discretionary. The above the line gross profit numbers, you really can't help what you sold something for. You can't help what your cost of goods sold is generally, but the operating expenses are a little bit more in your control. Operating expenses are key numbers for e-commerce sellers to understand because they reflect the revenue and expenses that you can control. So keep that in mind. A lot of times if you're valuing the business, a business valuation expert may or may not look at the operating expenses. A lot of times they'll just look at that gross profit number because it's up to you if you want to spend a lot of money on courses and training and coming to conferences like this. So here's an example of operating expenses. I just went through a few. Shipping supplies, subcontractor payments, PPC, pay per click. If you have a listing on Amazon and you're trying to get people to see your listing, you might want to spend more money on that. Here's examples of expenditures. These are not operating expenses. We have inventory purchases. That's the big cost of goods sold number. Everyone knows that. Amazon and eBay fees, shipping to Amazon. The way that you know the difference in general, because you've got shipping to Amazon and then you've got shipping post-sale, it really has to do with the sale. The sale is kind of the line in the sand. So if you're ordering inventory from China and you send it to the United States, that shipping fee, and a lot of times it can be very expensive, the customs bonds, all of the costs associated with that, you can consider that an element of cost of goods sold, but you can expense it when you incur it. You don't have to allocate that across the items that you sell. And that's an IRS rule, not an ANA rule. Okay, I already kind of touched on this, but the need to know number 2, this is a primary mistake sellers make, is they have no idea or only a vague idea what the value is of inventory on hand. Reminder, you will never be able to calculate gross profit if you don't know the value of unsold inventory on hand. Why sell online if you don't know whether or not you're making money on a monthly basis? This is Anna's tough love. Seriously, I talk to people all the time, and they have no idea how much they hold in unsold inventory. They have no idea what they paid for the inventory that sold, and I just don't understand that. And it's not a judgment that it's right or wrong. It's just you can't operate a business effectively and manage it if you don't know these numbers. Because remember, gross profit is the number one measurement of success of your business. It is not sales. Sales is the driver, but that is not the measure of success. You know, you've all seen those posts on Facebook. I sold this, and then someone says, well, what was your net? Well, that's kind of what they're going to. But I always laugh. Someone always has to say it. What was your net? Okay, the need to know number 3, cost of goods sold is the direct cost attributable to the sale of goods sold in a company. Not inventory purchased, but inventory sold. I see this all the time. Someone says, oh, I went out sourcing and I spent, I don't know, $1,000 on my cost of goods sold. I'm like, no, that's cost of goods available for sale. That is not cost of goods sold. The reason this really matters is inventory is on the balance sheet. You have spent money on this, but it does not make money until you sell it. Just to back this up, as a reminder, this is the cost of goods sold schedule from a Schedule C. It's surprising to me how many people haven't taken time to look at this. The Schedule C is the form used for a sole proprietor, but it's a very similar calculation no matter what your structure is. So you can see the first green. I want to see if I could use this thing. Right there. Inventory at the beginning of the year. This number becomes inventory at the end of the year and the next year. Here's a little hint, if you're starting an accounting software program and you've been in business for a while, when you start your opening balance sheet, this number comes from your tax return. This is how much you hold in unsold inventory at January 1st, 2000, whatever the year. Then you add to that the purchases. This is whatever you purchased during the year for inventory. If you subtract the inventory at the end of the year, it's cost of goods sold. That's the number right there. So there's a lot of debate in the community. Oh, I thought I could expense inventory when I buy it. There are certain IRS regulations that technically allow you to do that, but I want to talk a little bit about why that's not a good idea. First of all, you're accelerating taking the expense. So if you bought $200,000 worth of inventory in year 1, but you only sold $100,000 worth of revenue, well, you're starting off with a net loss. The other thing you're doing is you're accelerating the taking of the expense, so in future years you're going to have a lot of revenue that you can't offset with the expense. And here's another reason why. This is kind of the foundational reason. It's an accounting principle. I love this thing. The matching principle. I'm not going to read this whole thing, but this is the technical definition. But the idea is the revenue of the sale is matched with the cost of the inventory to arrive at gross profit. So what it's saying is you want to match the revenue with the expense, the matching principle. Because why would you want to take the revenue in year 3 when you'd already taken the expense in year 1? That doesn't give you a very good picture of your business. If you're turning inventory regularly, you have a really good turnover rate, this doesn't matter as much. When it really matters is when you have something like a private label business that might take you some time, a couple of accounting periods to turn. So you really want to be careful with this. And your CPA can help you with how you're going to record cost of goods sold, whether it's on the cash or accrual basis. But in general, it's better to match the revenue with expense, is my professional opinion on that. So here are examples of components of cost of goods sold. Obviously, the cost of the inventory during the period, but it also includes other things. These are costs associated with getting the product to market. Remember, the sale of inventory is where the switch happens. So we have the cost of inventory sold during the period, prep center fees. These can be considered an element of cost of goods sold. Inbound shipping, including shipment from overseas, we talked about that, and then Amazon or eBay fees. But if someone's been doing it differently in the audience, it's okay. The idea is to make a consistent, diligent effort. So you're not going to tax jail if you took the Amazon fees as an operating expense instead of a cost of goods sold item. It's not the end of the world. But the whole idea, remember, is to calculate, what did it cost me to sell this item? So you have the revenue minus cost of goods sold. And it costs you Amazon and eBay fees to sell that item. Here are our examples of expenditures not components of cost of goods sold. These are items that people get confused about. Shipping post-sale to the customer. This is if you're doing merchant fulfilled or you're an eBay seller. Pay-per-click. The reason this is considered an operating expense, this is somewhat in your control. You can decide how much you want to spend on advertising. Generally, advertising is not a component of cost of goods sold. It's not part of your gross profit. Inventory purchases, we've talked about that. And this is kind of obvious, the classes and conferences, that's kind of discretionary. You don't need to do that. I mean, it's great. Who doesn't love a conference? But these are operating expenses. Okay, I'm going to do a quiz. I'm sure you guys can already guess what the answer is going to be based on how I've been talking about this. But I want to give you a real-life example of why this matters. So here's the question. Would you rather have annual sales of $175,000 or $120,000? So most people would say 175, but I'm going to show you a real-life example of how this doesn't always work this way. Someone with higher sales than you can have a business that is not as healthy or profitable as yours. Common sense tells us that, but when we see people posting these great sales numbers on Facebook, it's really hard to say, oh, I'm glad I have less sales than that. I mean, because you just don't know what they're really doing. Remember, comparison is the thief of joy. I love that, because we all do it. You know, you want to measure how you're doing. You want to compare to others. It's kind of the barometer, but do remember this. So here is the example, and this is a real life. This happened to a client of mine. $120,000 in sales, well, this is the example. I'm going to go into an actual client example, but just so you kind of get the idea. Sales of 120, cost of goods sold, 60,000, 60,000 in gross profit. With operating expenses of only 10,000, they had operating income of 50. Same scenario, but the cost of goods sold was higher. 175 sales, cost of goods sold 125. The gross profit was 50. With the exact same operating expenses, this operating income was 40,000. So I'm going to go back. They had 50, they had 40. Be careful about increasing sales for the sake of increasing sales. You may be disappointed in the results. So this is a real life example I want to give you. This is a client of mine. She is a 60-year-old seller. She's been selling for about 10 years. She knows what she's doing. So she kind of got into this mentality of she really wanted to have 2 million in sales, and who wouldn't? That's kind of a fun number. So she'd been hovering about 1.5, 1.7 million. So she decided, I want to increase my sales from 1.7 million to at least 2 million in 2017. And it's actually really interesting what happened. So these are her real numbers. Her sales, 1.7, cost of goods sold, 1.3. She had gross profit of 421,000. So this is what she had left to pay her operating expenses out of. Her operating expenses were 182, so her net income was 238,000. That's not bad. That's a really healthy number, but she really wanted to reach 2 million. And she did it. She actually exceeded it. So she had 2.3 million in sales. I was really happy for her, so excited. Her cost of goods sold was 1.9 million. Her gross profit was 347. But look what happened to her operating expenses. They went up to 244,000, and we'll talk about why. So her operating income was 102. So just now that you know, let's flip back. Year one, you can see here her operating expenses were 182,000. And then here she had 244. So these are the results by the numbers. Her sales increased by $500,000. It's $585,000. Her cost of goods sold increased by $659,000. First step that was negative. Her gross profit decreased by $74,000. Her operating expenses increased by $62,000. So this doesn't seem like a lot, but the result was that her operating income decreased by $136,000, which is pretty amazing. So she and I sat down and we really dug into it to figure out what happened. So it was a combination of things. Her increase in sales required more investment in capital, so she had an increase in debt, increase in risk, and it really increased her stress. She wasn't anticipating how much more she would need to invest her capital to get the inventory, to get the sales. And so the other thing that happened was her gross margin decreased, and this is because the desire to generate sales required fast turns, which meant seller accepted lower margins to get the sale. She was very driven, like, I gotta get 2 million, gotta get 2 million. And she said there was almost this addictive nature to it. Like, she was so excited, and it's so funny. She's like this cute gray-haired woman, and she was so excited about this, and she just got out of control. Her gross income decreased by $74,000. That's over $6,000 a month decrease. That's pretty substantial. And this, I think, was really the big lesson. Her operating expenses increased by $62,000, primarily because she had to hire more people to process the inventory. But not only that, there was turnover. I mean, I don't know how many people here have people on your team, but you know the headache, someone comes in sick, or you interview them, oh, they're starting Monday. Monday comes, they never show up. That was a huge hassle. So she had to hire 3 additional part-time subcontractors, which was a management headache, and had to acquire about $250,000 in debt to acquire the inventory, only to net $136,000 less in 1 year. And I shared this with her permission. I'm not putting her picture up there and her name, but I'm really glad that she was willing to let me share this because I think it's a very important lesson. And I think when you're in those bigger numbers, over $1 million in the sales, 2 million, 2.5, it can really exponentially increase or decrease your bottom line if you're not careful. And I think another lesson for that, she said that she wished that she had kept up with her numbers monthly because she could have seen it happening. But I'm too busy. I'm just going to deal with accounting later. But you can't manage what you don't measure. So I thought that was really interesting. And now this year, she's on track to get back down to the 1.7 number, maybe even 1.5. And I think her bottom line will be better even than year 1 when we first started talking about this. All right, these are the top 5 mistakes I see of new e-commerce sellers, but I honestly see it with all sellers. It's kind of an easy trap. Signing up for multiple credit cards to fund inventory and operating expenses without being mindful of cost, interest, and annual fees. The other reason people do this is if they're doing RA, they want to kind of circumvent, like if you're going to Best Buy or Kohl's and you don't want them to know you're buying a lot of things, you might get a zillion credit cards, and it just ends up being a headache that I'm not sure is worth it. Each person has to decide for themselves. This one, my soapbox up here, not keeping track of the amount the seller holds in unsold inventory. This is why a balance sheet matters. And I have so many posts in my accounting group about the balance sheet. The balance sheet is so, so important. And if we have time later, I can talk more about it. If anyone wants to get on a screen sharing with me and I'll give you examples and teach you how to read the balance sheet, it's so important. It tells you how much cash you have, how much you hold in unsold inventory, what your debt is. This is the other thing I see. People are not aware of training and education costs, and they buy classes and they don't follow through. Not that anyone in this room has ever done that, but you sign up, I'm going to do it. It's 3 payments of $300, and next thing you know, you don't do it. It's just a waste of money. This is the other thing that can really, really add up. Not keeping an eye on PPC, Facebook ads, because it can destroy a margin very quickly. These can really, really add up. So a product that has a positive gross margin can all of a sudden not be successful because the seller spent too much on advertising. And this one is my number 1 thing that I hate, and I think we're all a little bit guilty of this, but I feel so bad when sellers work really hard and then they get into FOMO, the fear of missing out, and they attend conferences and events without a budget or without thinking about it because they know their friends are going to be there, and this is very fun. But have a budget, or say, I'm going to do 2 this year instead of 5, or I'm going to do 1 instead of 3. You can network without doing these things. I think they're great, but just be mindful and don't do it because you don't want to miss out. Because you know what, you may have to sometimes for the sake of your business, but it's just really important to keep an eye on that. So I'm going to go to the conclusion now, then we're going to do questions, and then I can talk a little bit more about some issues that I want you guys to be mindful of if we have time. So I've already talked about this. I have a free Facebook group, Accounting We Will Go. Please join it if you're interested. Again, there's no advertising there. It's just me answering questions, and it really is mostly me who does it. The group has a lot of members who chime in and participate, but I am like the admin, the control freak, and I run it all myself. So I really do like to keep a close eye on it to make sure everything stays on point. So what questions do we have here? Because I know you guys have questions. Yes?
The thing I struggle with besides the unsold inventory is the loss returns, whatever, you're getting rid of. Because of, can't sell it or donations.
So the question was, he said that he really struggles with the loss of inventory. Let me go back to, I just want to pull this schedule up here. It's from the tax return, but keep this in mind. Beginning of year inventory, or even if you wanted to keep up with it monthly or quarterly, inventory plus purchases minus ending inventory. Everything else is cost of goods sold. So you either have the inventory or you don't. And what people do is they get caught up in this thing, all right, someone bought this item and it got returned, but it's not sellable. Is it in my inventory or is it not? And I encourage people, forget all of that. Figure out what inventory you have on hand. You can run the report from Amazon that tells you what inventory you have at their warehouses. What is the value of that? Everything else is cost of goods sold. I think if you get too granular trying to figure this out, it takes a lot of time, obviously, because it's really difficult to track. So if you're really focused on instead making sure you know how much inventory you have at the end of the period, this is something you could do quarterly even. I have a guide on my website that tells you how to run the Amazon report to figure this out. So you literally have the beginning inventory that comes from the tax return, plus your purchases that'll come from your accounting software, minus the inventory on hand from that report. The difference is cost of goods sold. So you either have it or you don't. And if you have it, it's available for sale. If you don't, it's cost of goods sold, whether it was expired, damaged, returned, whatever it is. Did that answer your question? And it's not a lot of fun to do that report, but it's really the only way. If you embed your buy cost in your SKU, it makes your life a lot easier. Does everyone know how to do that? Just to make sure you know, there's a way that you can go into your SKU in Amazon and you can embed your buy cost. If you add it at the end of the SKU, you can write a macro in Excel to extract that and multiply by the cost, and it's a really quick process. It can take like 10 minutes. It's not that big of a deal. But of course, it has to be applied consistently, and when you first start, you don't know that. So, who else has questions? Yes. Oh, we'll wait for the microphone.
There you go. Thank you. Okay, so as regards to shipping as an expense, shipping to the customer, the way I understand it, as explained, is when we ship inventory into Amazon and Amazon fulfills that as part of their fee, the fulfillment fee of the shipping it to the customer is taken out, and that's considered a cost of goods.
Right.
So then why would you not include it as a cost of goods if you were shipping directly, like merchant fulfilled or on eBay, to the customer if you offered free shipping?
Well, if it's free shipping, you're not going to have a fee associated. You mean you offer free shipping to the customer?
Right. So the cost of the shipping is absorbed by us to the customer. So why?
Right.
So why would you break that shipping out as an expense versus just having it as a COGS?
Well, the general idea is when you're calculating your gross margin, your gross profit, you want to calculate all of the cost that you had to incur to get the product to market. And what you're talking about is when Amazon charges the seller, if they're fulfilling it, that's part of the Amazon fees. I mean, you technically could go through the report and pull that out and move it into an operating expense, the shipping expense, if you wanted to. I don't think it's probably worth the trouble. Again, it's about making a consistent, diligent effort, but the IRS definition is before sale or after sale. What does it cost you to get the product to market? After it's in the market, what are your expenditures? And those are operating expenses. So you're right, you could consider that, if you wanted to do that, a shipping expense, and go through and figure out how to calculate that. And again, as long as you do it consistently and diligently, it kind of doesn't matter because the bottom line is still the same. But you have to think about it also from a reporting aspect, what's helpful to you. And if it's helpful to you to get the shipping expense that Amazon has charged and move it to an operating expense, you can do that.
I would want to do it in reverse. Take the shipping expense from
out of the
shipping
Amazon
expense
fee.
and put it, so for like merchant fulfilled or something like that where you have free shipping, move that shipping expense to COGS.
You could do that if
Okay.
you wanted to. I mean,
Okay.
if you ever question, the IRS isn't going to care about that because it's an expense. It's not that it wasn't included. It was just operating as opposed to cost of goods sold. So if that's meaningful to you, then you certainly could do it because you'd be doing it consistently.
Okay.
I won't tell on you, don't worry.
I like your story about the 60-year-old lady you were helping with, and I think it's interesting. Like, you know, she'd already reached her optimization point year one, but when she won her goal was like 2 million sales, she actually incurred more expenses. So my question would be like, how does someone know they have reached that optimization point, and afterwards, if they want to drive more sales, the expense is going to be more?
That's really tough to quantify. Another thing that happened to her is she kind of changed the mix of inventory because some of the things that she was selling, she became restricted on. It was some Star Wars stuff. I'm not giving anything away. So then she had to change the mix a little bit. So that was another factor. I think it's really hard to predict these things. What I think actually will probably happen, she's on track. Now she has more stable employees that she had to go through this process in that crucial year to find. So that's kind of no longer an X factor. You know, really, there's so many moving pieces. I can move it back just to the conclusion slide. I don't really think, unfortunately, there's a good way to figure out what your business's break even is, but to the extent the most parts and pieces are stable possible, the more easily you're going to be able to assess that. I think really the best thing to do is to have regular feedback. Her takeaway was she wished she'd kept up with her numbers monthly. And even though she's my client, she said, I don't want to do that now, I'm going to just do it later. That ended up being a really bad decision, which I tried to tell her. But, you know, I'm providing a service. I'm not, you know, not her boss. And so that was her choice. So I think keeping an eye on it, she could have prevented some of that. She didn't really take time to learn the repricer properly. She spent a lot of money on this repricer, and it's a good product. But I think if she had, instead of trying to source more inventory and research more things, if she'd instead spent time on the repricer learning how to operate it properly, she could have had better margins. But if your business or her business isn't using a repricer, then that's not really a helpful thing because it doesn't even apply. So that's not really a great answer, but I think it just depends. Yes, ma'am.
Thank you. For a relatively new seller, what are some easy ways of keeping track of your numbers using software? What kinds of software?
I think, are you in Amazon? Are you talking about Amazon seller or eBay or?
Amazon.
Amazon. I think that one really good product to consider is something Inventory Lab or a similar product. Inventory Lab is here. I get nothing from suggesting them, but I think it's a nice way because it syncs with Amazon. It does a really good job of telling you your cost of goods sold monthly. So you can look at your revenue minus your cost of goods sold for the gross profit. And then everything else, you have a pretty good idea. You know what you're spending on conferences. You know what you're spending on all of these other things. There's a way you can put it in Inventory Lab. My caution is if you're using Inventory Lab, be sure you know what the limitations are. You can't reconcile your bank and credit card accounts. You can't tell how much your liabilities are. So that's why I'm a really big fan of a double entry accounting system where you have a balance sheet and a profit and loss. But I think as a new seller, done is better than perfect.
Well, I'm actually using Inventory Lab. I'm considering going in a different direction. So I was wondering about software such as GoDaddy or some of the other things that may be out there.
I'm going to be really careful how I say this. I think if you use GoDaddy, again, be careful of the limitations. It does not have a balance sheet. It does not give you the opportunity to reconcile accounts. So if you're going to use something, I would suggest considering QuickBooks Online or Xero. There's pros and cons to both of them. I'm personally a big fan of QuickBooks Online because I know how to use Xero also, but in my experience, QuickBooks Online is easier for sellers to learn. If you do consider it, there's a 30-day free trial But Simple Start is the only version you need. It's the least expensive version. Don't get the one that says it does, 80 million things. I think it's like $7 or $12 a month right now. Kind of get online and play around with it. But you still need to know your cost of goods sold number. So if you're choosing to track that yourself and not use Inventory Lab or similar product, I was explaining over here earlier about how you can calculate your cost of goods sold number from reports on Amazon. So make sure you're embedding your buy cost in your SKU, because you need to know when you sold these 28 million different things what you paid for them. So if you don't have a way to figure that out easily, it's going to be really tough to calculate cost of goods sold. Thank you. You're welcome. Don't hand the microphone to my husband. Do you guys have any other questions, or you want me to talk about some other things? I have a little list here of other topics I thought might be helpful, and it might prompt more questions as well, so feel free to chime in. One thing I wanted to mention, and this isn't about trying to get you to join my Facebook group, because you certainly don't have to, but I have a pinned post at the top that covers some of the top questions, and I thought it might be helpful to go through some of those. So again, it's in my group, but you don't have to join, I don't care. I mean, I care because it's important to me, but I'm not trying to force you to join my free group. So I have a monthly accounting routine that's in my Facebook group that explains what steps you need to go through monthly. So I thought that might be helpful. You can also go on my website and download this checklist for free. I think I might ask for your email address, but if you just want it, you can send me a message and I will send it to you. I don't need your email address. So monthly, this is what a monthly accounting routine looks like. And you might want to think about this as you're kind of getting going. It's a little bit different than if you're just using Inventory Lab or something like that. So the first thing you want to do, obviously, is if you're using an accounting software, all the transactions feed in automatically from your bank and your credit card. And so what happens is they go into a window and you have to tell the software what the transactions are for. So just to use a simple example, if you see Toys R Us, you know that you probably were buying inventory. And what you can do is you can set up rules. And so you can tell the software every time you see Toys R Us, automatically categorize that to inventory. So all of your transactions are going to feed in monthly, and you want to categorize them. And this is really nice if you try to keep up with it weekly, definitely monthly though, because a lot of times if you have a fraudulent transaction, you'll catch it this way. And also you'd be surprised if you let this step go and you procrastinate and don't do it, you'd be surprised how hard it is to remember what you did. I know that sounds crazy, but I see that happening all the time. So if you're using software, please try to keep up with it monthly. So you categorize all the transactions, and what that does is that puts them in the proper buckets or accounts in your financial statements. So you have your unsold inventory, you have payments to credit card from your checking account. If you put money into your business, you will see transactions for that, shipping supplies, PPC, all of these different things that we've been talking about. So once the transactions are categorized, that's just the start. It's not the end of it. What you have to do is the next step for Amazon sellers, which most of you here probably are. As you know, you get the deposit, but that's a net number. So you have your gross sales minus fees is cash in the bank. And I have a free template in the files in my group, but again, I'll just send it to you if you want it. And it explains to you how to record it properly, because you want to gross that up. You want to show, okay, I had 500,000 in sales, I had 200,000 in fees, and the net was 300,000, because the only thing that comes in is 300,000. So you need to do the adjustment. And the template in my group, thank you, I have 10 minutes. It shows you how to do that. Once you've done that, then you need to record cost of goods sold, because you want to make sure you understand of the sales I had, what did it cost me in inventory to get those sales. Then the last thing you want to do, which is really, really, really important, and a lot of people skip this step, and actually a lot of bookkeepers out there don't do this, and it makes me really frustrated for people who come to me for help, is reconciling the account. What that means is you want to make sure whatever's on your bank and credit card statement is exactly what's in your software. You want to make sure no transactions were missed, none were doubled, they're for the right date, the right amount, all of those things. If you reconcile your accounts and you know that what the bank says had happened is what happened in your software, the only other mistake that can happen is something is going to be in the wrong account. Reconciling is crucial. So those are the steps. Again, you can do this at year end. Please at least do it quarterly, but monthly is ideal. There's no reason to have a business if you don't know how it's doing. I think some people are afraid of the number. They've told me, well, I just don't want to know, or I'm so behind, I don't know where to start. Forget all that. That's an excuse. This is hard. It's a pain. If it wasn't, everyone would do it. Get on your grown-up clothes and just sit down and get through it. Just start where you are and get it done. Hi. Okay. Does anyone have any questions about that? Because I'll keep going to some of these other kind of FAQ things. And obviously, after you've done all that, you want to review your financials. Make sure that the balance sheet looks okay. Make sure you understand the profit and loss. Key things on the balance sheet to look for. I highly encourage you to keep an eye on how much debt you have versus unsold inventory. The rule of thumb for brick and mortar businesses for the longest time was 30%. So if you had $100,000 in inventory, the industry standard was 30% debt. That doesn't necessarily apply anymore. Things have changed. You need to know the number and you need to make sure that you are comfortable with it. I work with some people, or just people in my group, who are big. I have no debt and I sleep well at night. Other people run it up to like 90%, like I gotta buy this inventory because I'm gonna make $1 zillion in Q4. Only you know what's best for you, but just know that number. You can't do that without a balance sheet. All right, let's see. Some other top questions are, how do you calculate interest on a loan? This is really important. I think some of the loan services like Cabbage, and there's some others out there that people use a lot, make it really tough to do this. I think Amazon does a great job of understanding or explaining to the borrowers or to the sellers what the debt cost is. Make sure you know that, because it can really add up. And it's kind of common sense, but you'd be surprised how many people don't keep an eye on that. Here's another question that comes up a lot. If I'm going to hire a CPA, do they need to have e-commerce experience? And my response to that is generally no, but it kind of depends. So the reason it's no is because any CPA who has experience with at least an inventory-based business should be able to provide services for you. It is up to you as the seller to explain to the CPA how it works. I get paid bi-weekly. This is the report that tells me my gross sales and my fees. This is how the business works. If you can't do that and explain it to your CPA, then you have bigger problems than just your taxes. But I do think if you have a CPA with e-commerce experience, or specifically Amazon, it kind of saves some of that. It's a little bit of a shortcut, so you're not explaining to this person how the system works. But you should be able to explain it. So don't let that be a reason that you're not working with a CPA. If you don't understand how it works, let me know, email me, send me a message through Facebook, and we can talk about it. But you've got to know that at the very least. And I know this sounds like common sense, but you'd be surprised how many people really don't understand it. They say, well, I have cash in the bank, so I guess my business is doing well, but that's not a good idea. So the answer to that is it depends. I think there's a nice shortcut. If you work with a CPA who already has some clients in the same arena, you don't have to go through the whole thing, but that should be like one 30-minute phone call. But at least make sure they have experience with an inventory-based business, or they're willing to work with an inventory-based business client. Cost of goods sold is a very large expense, and it's the responsibility of the seller to understand how to calculate that, and a lot of CPAs get nervous about that. The one thing I want to add also is, even if you hire a CPA to do your tax return, it is your responsibility, not theirs. If there's a problem, the IRS is coming after you. Now, granted, if the CPA did it wrong, there's some mitigating factors, but keep in mind, they're not going to do it for you. Or if you show up with a brown bag full of receipts, it's going to cost you a whole lot more. All right, we're almost out of time. Are there any questions? I'll keep going through some of these FAQs. Oh, yes.
Is there any resource that you recommend for like basic understanding of how accounting, all the different terms and all that stuff?
Yes. You know what I love? At least in my area, it's very, very good. The SBDC, the Small Business Development Association, I don't know if anyone here has worked with them. They're part of the SBA, the Small Business Association. Oh, SBDC is the Small Business Development Center. They're part of the SBA, which is a Small Business Association. In my area in Atlanta, they're fantastic. I took a course there about doing an import-export business. I think it was like $60 for a full day working with people who had done it, because I didn't mention this, but I have a few items for sale on Amazon myself. They're home textiles from India, like bedspreads and table runners, just because I think it's fun and I like to do it. But I took this class, but they have great classes, and they're usually free. Sometimes they're even online, so you don't have to go in person, or it's like $10 or something minimal. So I really like the SBA and the SBDC. SCORE is another outreach program they have. And then they have programs where they match former executives or experienced lawyers and CPAs with people wanting to grow their business, and it's a minimal fee. So I think it's a really good free resource. I will say there was someone in my group recently who, went on and on about how great it was, and she went, I think she was in Oklahoma. Sorry if anyone here is from Oklahoma. But she said, well, maybe they're just terrible in Oklahoma, but she didn't have a good experience. So I don't know if it varies, but all the other feedback I've gotten has been very good. So if you live in Oklahoma, maybe don't do it. But other than that, I think they're fabulous. And I love that it's low cost. And of course, Google, but it's, you start going on Google, learn about accounting, that's just a nightmare and boring. Let me check the time. Okay, does anyone else have any questions? We have about 4 minutes left.
Husband.
No, don't give him the microphone. It's all a lie. It's all a lie. One thing I want to recommend also is for organization. I think that's something people really struggle with. I love Dropbox because it's cloud storage. And what I suggest is to scan and save to Dropbox. Bank statements, if you want to save receipts, which is actually because you should save receipts, scan them, store them to Dropbox. The bank statements and the credit card statements, you just need them as support for your tax return. If you're ever audited, you're going to wish you had them. If you're working with a bookkeeper or you're keeping up with your books yourself, you need them because you need to reconcile. So just go to your bank and credit card. You can download the PDF sometimes straight to Dropbox if you have it set up as an external drive on your computer, or just save it on your computer and put it in Dropbox. Evernote is another good tool. I don't know if anyone here uses Evernote. It has a lot more search capability, and I like that it has, for receipts, it has a little bit better reading capability. Dropbox is really just storage, but I love Dropbox. That's how I communicate with my clients. We have shared Dropbox folders, and we put everything in there. So it's a really good tool. And if you stay organized at the beginning, you don't have a nightmare at year end. All right, we have like 2 minutes, so I'm not going to start on something new. Does anyone else have any questions? Well, I appreciate your time today. I expect all of you to join my group. No, I'm kidding. But thank you so much.